Good afternoon, everyone. Welcome to the Growth Fund 4 quarterly webinar. We have 500 attendees, mainly investors. So this is going to be formatted and presented as investor update. If you're a new investor or potential investor, I think you'll still get value for listening about how the portfolio has been constructed, as well as the progress that's been made to date. My name is David Scherer. I'm the co-founder and co-CEO of Origin Investments. I'm joined today by my longtime colleague and friend, Tom Briney, who runs our Western operations out of our office in Denver. Tom will be taking over the presentation in about 15, 20 minutes. Tom joined us from Blackstone 11 years ago, and he's been instrumental in building out the platform as well as this fund itself. So I'm going to jump right in just a little bit about format before we get started. Typically, these are about 30 minutes in duration, the presentation. You will get a copy of the presentation if you want it. So don't overly focus on that. I would mainly listen at this point. The last 25 to 30 minutes will be Q&A. Everyone's familiar now. There's a Q&A box at the bottom of Zoom. You can use that Q&A box to ask us questions. We got about 35, 40 questions emailed in prior. We're going to try to incorporate the answers into this presentation. If you feel they weren't answered, just re-ask the question again in the Q&A box. And Tom has made some notes of themes to make sure that we cover in the Q&A if he doesn't think I've covered them now. And I think that's it. So we're going to jump right in. We will give priority to the live Q&A and the Q&A because we want to make sure that people are rewarded to attend live. So let's get started. So what is Origin? I'll be very brief. Many of you on the call are longtime partners and partners in many funds, Growth Fund 4 being the latest one. But Origin is a manager. We've been around since 2007. We have 45 professionals that only think about real estate or client service for our real estate investment partners. We have offices throughout the country, but specifically, we only invest in what we call the Smile. And the Smile is the Southeast Texas and the Southwest. We've been living and integrating into these communities with our professionals who both source and execute business plans since 2015. And so we have offices obviously in Chicago, our hub, but we don't invest really in Chicago. The regional offices are really where the investment activity flows through, and that would be Charlotte, Nashville, of course, Denver, that's where Tom lives and works, and Dallas, which covers our Texas market. We do have a presence in Florida and Atlanta as well, but I wouldn't include those in the official Origin office category. In terms of what we do, we only invest in multifamily. That's all we do. So we're only in, several states that we determined are growth states and lifestyle states and low tax states and business friendly states. That's why we're there. But then we also only invest in multifamily. And we found that the more focused we've become, the better we've become at operations and all of its forms, whether it's development, risk management, multifamily operations. But interestingly enough, in sourcing, the more specific we become, the more prolific we become at accessing quality deals, because I think the market really understands what we do. And what we do is we develop, operate, or lend to multifamily real estate. That's what we do in our target markets, these growth states that I talked about before. What I'm most proud of by far, actually two things. One would be we've been able to maintain our senior leadership team for the last 8, 10, 12 years. That's a big reason why our returns are so high. Is Tom, for example, has been with us 11 years. Tom, in my opinion, is one of the best in the country at what he does. But I could say the same thing about Dave Welk, Mark Turner, Michael McVicker. Our controller, Priya, has been with us 13 years. She has the record here at Origin. And of course, my partner and I, Michael, have been together for 15 years. What have the returns been historically across our 8 funds? 24% gross IRR, 2.1% average equity multiple. And that puts us in the top decile as a management team, which we're really proud of. That means that we're a consistent performer for the last 7 years. And we think we're positioned to keep doing that. A lot of our investment partners are drawn to the fact that so much of the capital in our funds is our own. 75 million of the capital invested has been either mine, my partners, or increasingly now our senior management team as well. Tom's a big investor alongside you. Our growth has been pretty extraordinary over the last 2 or 3 years. We now have a little bit over 2,900 active investment partners. And if there's investment advisors on the call, either because you're an investor now or you're considering it, we have 60 investment advisory partners at this point, meaning that they actively invest on behalf of their clients in our funds. And of course, the consistency of returns is sort of encapsulated by the 0 realized losses. We've never taken a loss on an investment, which we're really proud of. Next slide, please. So Origin, I want to give you a little bit of an update on what we're seeing in the market. And one of the interesting benefits that we have is we're not just in the market for Growth Fund 4, but we're also in the opportunity zone development space through those funds. We're in the multifamily credit space. So we're very active and we see a lot of deal flow. Some of the questions that we get on every webinar and the pre-emailed in questions are some iteration of, how are you managing interest rate increases? How are you managing inflation? What are you seeing in terms of multifamily valuations? And so I will integrate that into this brief discussion, but interest rate mitigation at Origin, we're extraordinarily active, and this fund is no different. The reason, and I'll jump to the second bullet, the reason we're so active in mitigating and hedging interest rates is we believe we're building on average to a 40% margin. And so what I mean by that is if we're building for 250,000 a unit or 300,000 a unit, we will be selling for, in the $250,000 case, the market for stabilized when built is 100,000 higher. Or in the $300,000 case, we're selling for 4.25. And so that margin is both our profit if we execute, but it's also risk mitigation, because if the market were to correct, we're not losing money, we're just losing profit. And I actually view well-executed development with the amount of experience that we have. This is the 5th fund we've developed multifamily for. I think that it's actually an extraordinarily low-risk proposition. And I will stand by that through any market cycle. Why we hedge interest rates is when you're operating in a really high margin business, which we believe we are, we want to control the variables we want to hedge the variables we can't control. And so, as I sit here today, I can't control where interest rates are going. So I want to hedge that, because the things I can do, and our team does, is find the right properties to purchase the land at the right price, pre-develop, mitigate risk, execute the construction, operate the asset. These are things we think we do well, and we can control that. So interest rate hedging this year has included what we call swaps, which is essentially swapping variable debt for fixed rate debt, and swaptions, which is a purchase of an option that allows you to swap debt for a duration of time. And that's been incredibly beneficial for this fund and others, because interest rates have actually gone up quite a bit, but we had hedged them prior to them going up. And so one of the things that we talk about a lot at Origin, we don't want to worry and tell you we're worried or concerned. We want to be active and do things about it. And we're an action firm. So we will tell you what we did, not what we're concerned about. And I would encourage you, because risk management is a really big part of any fund manager. Ask other fund managers what their actual strategies are for interest rate mitigation or hedging. And they really should have an answer, not just we're concerned, or that's worrying is not a strategy. And then in terms of protect and grow, this fund is a mirror of what we're trying to do at Origin. So remember I talked about we have 2,900 clients. That's true. Active clients, partners. Those clients are all taxed. Every single client we have pays taxes. My partner and I, and Tom Briney, who's on this call, he pays taxes. And so one of the things we're trying to do is protect and grow capital, but then also be tax efficient. And what we found is the most tax efficient is to build great assets, operate them, and don't sell them. Keep them, because you're not paying capital gains taxes, you're letting the values run. And the beauty of real estate once built is you can depreciate it against operating income, getting cash flow with no taxes. And that's incredibly lucrative for a tax investor. And so this fund is no different. We will develop, we will create 40% margins. Those margins will build wealth that you can either sell after that 4-year period and exit the fund, or you have the option to stay in the fund. And now you have an amazing basis. Your basis is 250 or 300,000 a unit, when the market, if it doesn't move, is significantly higher, 100,000 higher. And you're going to get great cash flows, and you're not going to pay taxes. And that's how you actually get wealthy, is not by getting 16, 17% IRRs every 4 years and then paying taxes and then reinvesting post-tax money into the next 16, 17% IRR. That's a losing strategy. A winning strategy is to stay in, be in a great basis. And that's the option you have here. You don't have to do it. You can take the high IRR and pay taxes and move on, or you can elect to stay in the fund, and essentially you're developing this tax efficient stream, which we think is a better way to invest. Of course, when we do that, we're actually going to lower the management fee. And so once, development is incredibly difficult and time consuming for us. And so once we move into that phase, if you opt to stay in, we don't want to charge you the same rate. That's not fair. We lower the management fee, and it starts to act like income plus, which is a 1.25% management fee, not a 1.5%. And so everything we do at Origin is both for the tax investor. We believe long-term holds of quality real estate is the way to build wealth, but we also want to be fair, and we believe that we are in all of our fee structures, and this is reflective of that. Next slide, please. So this captures really what we talked about. We have a credit committee every week where we analyze the portfolio for the various funds, but also look at new deals. And we really view the world as a series of probabilities. There's no future. There's just a future that will unfold and a series of probabilities within that future. So where are interest rates next year? I don't know. But I know we're going to hedge them because it's a risk we have to control. Where's the economy? Now the consensus is, we're going into some form of recession. Is that true? We don't know, right? But it's probable. So when we're looking at this IRR chart, we're breaking this fund. This is a portfolio of a dozen assets, and saying, this is what the future looks like in a recession, in a higher interest rate environment, in a very, very difficult future environment. That's our downside. And the upside is, this is our future in a world where cap rates, don't keep expanding and rent growth is high. This is what it looks like. And this is over this 3-year development period. And that's what we're looking at. And then as an investor, if you're in the fund or if you're considering the fund, this is how I would encourage you to look at the fund. This is an 8 to 23% range part of your portfolio, a 1.3 to 1.9x multiple. The base case, of course, is in the middle, but that's the continuum of outcomes that we think are plausible in this fund. And what's interesting is we found that last year and the first 2 quarters of this year, multifamily real estate isn't correlating with the stock and bond market. And so you as an investor, if you're not just thinking about this fund, but how to put together a portfolio for you, the investor, you're your own CIO, right? You're your chief investment officer. The nice part about multifamily real estate is it's proven to be this incredible inflation hedge because we get to reset rents as inflation goes up. And, you know, I was surprised by this. I knew that the cost of multifamily housing or rents was a significant part of CPI, the consumer price index that everyone's so focused on, you know, and literally right now, I don't have access because I'm on this webinar, but the Fed is coming out with how much they're going to raise right now on 115 2-day, probably going to raise 75 bips. Why? Because the CPI keeps going up. It's, you know, 8 or 9%. So as an investor, you know, one of the things that happens in uncertain times is investors don't want to invest. They want to hoard their money. But in an inflationary world where prices are going up 8%, you are losing 8%. It's a very, very bad time to hoard cash. Like you're eroding 8% a year on cash. And so you don't stop investing, you change the way you invest and you look for asset classes that don't correlate with everything else. You know, bonds have done terrible, stocks have done worse. They're all correlating. They're all going down together. You want to find things that aren't. Real estate isn't. This is the continuum of returns that we believe this fund, as of today, will produce. Next slide, please. So Tom, is that my segue? Are you covering this?
Yes, sir.
All right, so without further ado, the smarter of the two is ready to roll. Thanks, Tom.
Thanks, Dave. I'll disagree with that, but we'll agree to disagree. For real quick reminder, the Q&A is open. We've started to receive some questions in there. If you have questions based on what Dave said or what I'm about to say, feel free to put those in the Q&A below and we will get to them after I talk here for a few minutes. So with that, let's jump into the pipeline of Growth Fund 4. I would argue that this is a very, very deep pipeline. We currently have 12 deals across 8 markets, totaling a little bit more than 3,300 units that are either closed or likely to close in the very near future. The total equity commitment across these 12 deals is about 190 million of fund equity. If we stop raising at our target of 200 million for the fund, that would equate to about 95% committed, invested today without any future deals. We have 3 more deals that are a little bit early in the pipeline to really represent here as a high degree of confidence. That represents another 60 million. And so if we were to hit our cap in the capital raising for this fund, that would equate to 96% invested. The reason I tell you all that is because it's very unusual for a closed-ended fund to have this magnitude of visibility this early on in the fund. This is, you know, we officially launched the fundraising for this back in January of this year. So it's only 7 months old. And to have really anywhere from 95 to 100% of the equity committed at this point in time is highly, highly unusual. And that's a very big advantage to the investors of this fund, Dave, myself, and everybody on this call. The reason we're able to do this is because we get into the projects very early. These are very long lead time deals. And so a lot of these deals we've been working on for well over a year, sometimes 18 months or even more. And we're able to put these under contract early, and that provides a big advantage to the investors. Many of these land sites that are under control, acquired, or under construction are deeply in the money. So a lot of times, at least 30, 40, 50% of the money, sometimes 100% or even more in the money. So said differently, an asset or a land parcel that we bought for $20,000 per unit could be worth 30, 40, 50, or even $60,000 per unit today. Now, we as a fund manager and our partners do not mark these land values up at all. They go to the fund at our acquisition basis. So although we may have acquired the land for $20,000 a door 12 or more months ago, you are benefiting as the investor by getting that land basis at $20,000 a door today, even though they're worth $40,000 or more a door today. One thing that I like to focus on that we haven't really focused on in the past with these webinars is this idea of BFR or SFR products. So these are acronyms that we use in the industry quite a bit, especially more so in the last couple of years. And BFR stands for Build for Rent, and SFR stands for Single Family Rentals. We use them kind of interchangeably. And ultimately what BFR or SFR is a low density apartment community. In low density meaning rather than building 3 or 5 stories of apartments as you're used to seeing in a garden project, we're building 1 story. So a single family feeling home. And that could be a true standalone single family home. It could be a townhome adjacent, with a couple of townhomes adjacent to one each other. But the reason people are really, really attracted, these renters are really attracted to these, is because they are quieter than a traditional product. They feel more like owning a home, but you don't have the hassle of owning a home. You don't have the mortgage. You don't have the repairs and maintenance. You get the benefits of not having to have somebody living above you or living below you or even living next to you in most cases. And so it's a much quieter feel, but you're still renting. You don't have the down payment. You don't have the maintenance, that sort of thing. And so what that means from an ownership perspective is that these typically outperform in a really big way on the revenue side, and the expenses are not meaningfully different on the operating side. So this is a product type that we've been chasing for several years now. We really started digging into this product type about 5-6 years ago on the acquisition side, but we haven't had much opportunity to buy because it's a newer asset class in the apartment community space, that there isn't a lot of it available to acquire. So we've decided to build it. The challenge with building it is because it's a lower density site, you need more land to build the site. So we usually take 10 acres to build for a traditional apartment community, you now need 30 acres to build. And it's very, very challenging to find high quality sites in great locations that can have the type of unit count that we're looking for to be operationally efficient. And so it's very challenging. And the reason I bring all this up is because we have 2 BFR, SFR projects in our pipeline today. The first one is Austin, 310 units in Austin. And then further down on this slide, you see the 103 units in Atlanta. Both of these are that project, that unique asset that we're looking for, that very tough to find and very highly performing asset type that is in the fund today. And we have one more in the pipeline that I'm optimistic we'll get our hands on, but it's a product type that is really an addition to the traditional multifamily that we've historically built. It is really complementary to everything that we do. So I think the question now is, how do we build such a deep pipeline of these unique asset types? So Jeff, let's move to the next slide. The answer to the deep pipeline is proprietary deal flow. We spend a huge amount of time not just looking at opportunities and ciphering through the best deals that are available, but we build deep relationships that are proprietary to Origin. And these are a handful of our partners that are shown on the slide here. It's the Jackson, Dearborn, Rise, and Geffen. And these are all groups that are highly, highly respected in the industry. And more importantly, they're vertically integrated. And what that means is they have their general contracting arm as part of their development business. So they go out, they find the site, they select the site, and they program it for the unit count, the unit mix, whether it's BFR, traditional 3-story or 5-story, whatever it might be. And then they have the ability to actually build it. There's not a third-party general contractor in place. And that really gives us a lot more control on the quality and the value of execution. So we are able to more tightly control the quality of the asset that's built. And when you're talking about holding an asset, not for 3 to 4 years, but 10 years, 15 years, 20 years, you want to make sure that quality is very, very high. And the second piece is we can not only control the quality, but we can control the pricing with which we execute that quality. Because we are using a vertically integrated partner in many instances, we have true clarity as to what the pricing is. We're able to talk directly to the subcontractors and say, hey, we need to tweak this, we need to tweak that. It allows us to get the best possible pricing that's available out there, which sometimes you get and sometimes you don't get with the third party, but there's a lot higher level of trust that the execution is optimal when you have a vertically integrated partner. So we have these vertically integrated partners that we've been talking to since 2015, 16, 17, many, many years. And we find that we are a very good cultural fit. And so we create this programmatic venture. And what that means is we create a box that both groups agree are our target investment profile. That could be 250 to 300 units in certain markets. And we agree on this mutual box and target strategy and say, okay, if you find that and we agree that the underwriting is what it should be, then we'll do that deal. And before it goes to anybody else in the market for capitalization, we have that conversation. We can rinse and repeat on our documents. And it's a really, really smooth process because of this programmatic venture that we create. And the advantage to both groups is that we get into these projects very early. So as I mentioned earlier, we've been working on some of the deals in the pipeline now for a year and a half or more. And the advantage to the investor is that we get to do input design recommendations into these projects. A lot of these partners, whether it's Jackson Dearborn or Geffen, are regional in nature. So they're really, really good in Texas or really, really good in Phoenix, but they don't see what's happening in Charlotte or Atlanta. But because we have not just 3,300 units plus in this fund, but we also have 2 QOZ funds, and we see a huge amount of evolution in the multifamily space as a firm. And we talk every week about what we're seeing internally. Here's what's working, here's what's not working, here's the challenges we're seeing, and here's the benefits we're seeing from new things that we've tried. And we can transfer that knowledge from Atlanta to Phoenix, for example, or to Denver, to our partners in different regions and say, here's what's working, here's what's not working that we're seeing in our portfolio. And ultimately, the result is a better product for everybody across the board. And that allows for higher returns, which ultimately flows to the bottom line to you, the investor. We also are able to get better terms from our partnership because we're taking that risk of time and money early on in the process. We're able to extract and compromise on better terms with our development partners so that there is more return that flows to the bottom line, to the investor, and really creates a better fund product for everybody to invest in. And then finally, it gives us a lot of certainty in deal flow. The reason we're able to have 90% certainty in our pipeline today is because we've been working on these deals for a year and a half, and really the investor is benefiting from that. The deals that we're looking at today are likely to be part of Growth Fund 4 or Growth Fund 5. We're looking at 2023, 2024 opportunities today that would go into those future funds. And having that clarity into the future really helps us pace our products with our investors, as well as our guidance and clarity with our partners. And having that view down the runway gives us a lot of advantages in managing expectations across the board. Ultimately, this is a mutually beneficial relationship for everybody. It gives us the pipeline that we feel comfortable with. Origin does a really nice job developing and managing our investments, and our partners do a really nice job with building, being the general contractor, and site selection, finding those really unique, really opportunistic sites where we can build something that's different, that's better, and it allows for us to outperform over the long run. That's how you get a 10-year track record and a top decile performer. Okay, let's focus then on a singular deal. Jeff, next slide. 277 Clifton. This is in East Atlanta. This is our newest deal to Growth Fund 4. This is in the Memorial Drive corridor of East Atlanta. This is the type of product I was mentioning to you earlier. This is a BFR or single family rental type community. It's only 103 units rather, but it's townhome style. So although it looks like it's 3 or 4 story product, each one of those units is a vertically structured townhome. And that means at most you'll have, as a renter, have one person on either side of you. There's nobody above you, there's nobody below you. And although this is only 103 units, which is on the lower end of where we would like to see product from an operational efficiency perspective, it's a super unique location from an infill perspective. As I mentioned earlier, this BFR, SFR product is really challenging to find great sites because of how much space it takes to build this low density. But finding one that's infill like this in the East Atlanta location, the Memorial Drive corridor, is very unique. And it's one that we said, although it's maybe on the lower end of where we'd like to be from a unit count perspective, the location is so unique, we're really going to run with it. And the reason we like that is because we have boots on the ground here. Dave Welk runs our Southeast operations. He's been with Origin for as long as I have. And he is, again, a prolific deal sourcer. He actually sourced a deal that was about 2 miles from here, 675 Highlands, which was part of Growth Fund 3. We sold that about 2 weeks ago for a very healthy profit. And this is a continuation of that boots on the ground, understanding where the path of growth is going. This is where the trendy bars are starting to show up, where the restaurants are starting to show up. And we're actually demolishing assets that are here existing so that we can build this higher and better use in place. This asset is also being developed with an existing partner. Urban Realty is the second deal we'll perform with Urban Realty. We had one in the western part of Midtown Atlanta with Urban Realty. It was a very successful investment as well. And so back to that relationship, that the first deal was acquired, executed, and sold. And now we're on to the second. So we've known Urban Realty for 7 or 8 years at this point. And it's a relationship we trust. It's a relationship we know. It's a relationship that we highly, highly value. And so we're eager to move forward with this one. We have already completed the demolition on the site. That was done last week. The existing assets or existing complexes which were on the site were demolished last week. And we should be digging a hole this week and going vertical in the very near future. So this is a very unique asset. This is really an example of what you can expect to get in this fund. Unique, high quality assets in barriers to entry type locations with quality sponsors. And you can see the returns shown here at 17 IRR and a 2x equity multiple. This is indicative of what the fund is going forward. Now, again, that range is more in line with what Dave Scherer mentioned earlier, in that the downside is probably a 13 or a 12, and the upside being in that low 20s. So a very representative deal of the fund, one that we're all very excited about, and I'm eager to see this one development get underway. I think with that, Dave, let's move on to Q&A.
Thanks, Tom. One of the things I want to add, and I'll answer the first question too, Tom, because I'm going to follow up with fee structure stuff and go in more detail. But risk mitigation actually starts with underwriting. And so the way that we underwrite the deals, when Tom is saying this is a 17, but it might be a 12, the upside might be a 22. In our underwriting, we don't trend rents during construction at all. And so to give you an idea, like rents almost always go higher. Now they're going a lot higher, but historically rents go up. I mean, they're even in a low inflation environment, they go up 2 or 3%. We don't trend them in our underwriting. That's our base case. That's the 17. So if you're worried about rents not going up, let's say they stagnate for 3 years. That's our base case underwriting. In terms of cap rates, we get these questions a lot. Well, what if cap rates go up? In every model we have, we drift our cap rates 2% higher per year. We don't know. Tom Briney, as he sits here today, he has no idea where cap rates are in 3 years. Neither do I. But in a world where they're up 10%, we've already modeled that. That's already in there, right? In a world where they're unchanged, we're way ahead of the game. The 17 isn't a 17, it's higher. And so part of risk mitigation is actually how you underwrite a deal. And the reason I'm telling you this is you as an investor, unless you understand finance and you understand real estate modeling and you understand defensible inputs, what's an expense ratio? Even within that, what's for that market a reasonable tax assumption, a reasonable payroll assumption, et cetera, you won't know whatever manager or deal you're seeing is legitimate or not. You don't know that. So either pick a management team you really trust, or if you're doing deal by deal, hire a consultant. It's money well spent. Spend $5,000 or $10,000 to figure out if that underwriting is accurate, because you might be looking at something that's a 20 that's actually a 5 base case. You don't know that. Okay, so I want to jump into Q&A, and Tom, I know you took some notes on themes of the email in, so at some point, if you didn't think they were covered, let's circle back. But I mentioned earlier that real wealth is created by building great assets and holding them. In this fund, as an investor, you have the option to get out or stay in. That'll be after the development period. People who want out will be taken out generally through refinancing assets, which will create liquidity to take people out. But the fee structures do change. And I mentioned one, but I want to go a little bit deeper. First of all, there's 2 share classes in this fund, and it's completely dictated by how much an investor invests. So 5 million or above, you pay a 1.25% management fee. Anything below 5 million, you pay a 1.5% management fee during development. And then after which, if you opt to stay in the fund, both share classes shelf down 25 basis points. So if you were paying 1.5 because you're a $100,000 investor, you go down to 1.25. If you're paying 1.25, you go down to 1. And then in terms of the promote is 15%. If you leave at the 4-year post-development, if you stay in long-term, it mirrors our Income Plus fund, which it goes down to a 10% promote. And the reason for that is it's an operating business now. It's a cash flowing business. In both cases, management fee and promote, we are doing less intensive work. We're not having to rebuild it. Although I will tell you, one of the benefits of all of our funds is we will value add these assets when appropriate, meaning if it needs a refresh, a new backsplash, new granite, new appliances, we'll be monitoring the market to do that, to both compete with new product, but also to raise rents. Because ultimately, if you invest $4,000 into a unit and you can get a 25% ROE, return on equity, you're doing that, right? So we'll be stewards of yours and our capital in terms of when to do that. That's part of active management. That's what you're buying into. But these are the differences in fund structured fees. Thanks for your question. So Tom, I'm going to defer to you. You can just pick any question on the live. We have 14 at this point.
Sure. I'm going to go down here and clarify towards the bottom. This is anonymous, who asked the question, are you confident your operations team can handle BFR, SFR? Is it a different business than multifamily in terms of being less efficient operationally than multifamily? This is a great question. It's something we spent a lot of time on. And one thing that I want to clarify is there's a difference between the BFR, SFR trend that was occurring from 2010 to 2015, where you were buying single family scattered sites. So you buy a home here, you buy a home, a quarter mile away, another home, you get 300 homes along a municipality or an MSA. These are very specifically built 200-300 homes on a singular site that are operationally efficient because they're not scattered. So you don't have a guy who's driving his truck to fix a refrigerator across town and then back across town, back across town. The operational efficiencies when you get to scale are very, very similar to that of traditional multifamily. Now, one thing that is different that we've discussed at length and studied at length is the capital reserves that are required or that we expect to be required in a BFR type product. There are more roofs, there is more siding, there's more just general maintenance that will need to occur in a BFR SFR project because you have more walls, because you're not stacked. So we do underwrite for that and provide ourselves some cushion so that when there's time to replace roofs, we've got more capital in reserve. When it's time to repaint the buildings, we have more in reserve. But those reserves are about, we'll call it 25 to 35% higher. But that's just one singular line item, and all the other line items are pretty consistent between traditional multifamily and BFR, SFR. But the rents across the board are, we'll call it anywhere from 10 to 15% higher. So the advantages of the revenue generation far exceed the disadvantages on the expense side. So it's a great question. And thank you for the question, Anonymous.
I'm going to answer a few. Anonymous question, can you add to your committed investment amount if you're an existing investor in the fund? Yes, you can. We have 12 people in client service. Each of you, if you're an investment partner, you have a contact, or you can always just email me, David at Origin Investments, and I'll make sure that we find who your representative is, and they'll work with you on that. The cap of this fund is $250 million. I believe we're at 150 million, maybe just under 145, I believe. Vince told me earlier this week. So we will continue to raise until we reach that cap. And by the way, that cap is there because it meets equilibrium on the development side. We've already fully sourced the fund. We know what it is. Tom shared the assets, and that's going to be what we need on the equity side for it. Another question, Richard, thank you for your question. The minimum investment is $50,000. I believe our median is around $250,000 in this fund, meaning the average investment partner invests about that amount. And of course, we have larger investors, family offices, investment advisors who are a bit more than that. And then last one, and then I'm gonna hand it back to Tom. Kai, thank you for your question. He has a question about cap rates, which is a great question. And I didn't do enough market commentary. And so I'll cover that as well. One of the benefits we have at Origin is, we have 8 funds, and some of them we're not raising for, obviously. They're, Fund 2, Fund 3, those have been closed for years and years. But for example, in Fund 3, we took 3 assets to market in the last 100 days, maybe 120 days, and all in great markets, one in Dallas, one in Denver, one in Atlanta. Tom mentioned the one in Atlanta, 675 Highlands, that closed, no retrade. There we did very, very well. That's a Fund 3 asset. Our Denver asset, there was a slight retrade, but we believe we sold it at extraordinarily good price. And then the third asset, which was in Dallas, which is irreplaceable real estate in Highland Park, Dallas, amazingly located, generational real estate, that fell out. And just broadly, I would tell you that 90% of multifamily real estate deals are falling out right now of contract, or retrades are being demanded. And the reason is, simply put, interest rates. The risk-free rate was 1.6%. When I say risk-free rate, I mean 10-year note yield. It was 1.6% January 2nd. Today it's 2.77. I just checked when Tom was talking. The Fed just raised rates another 75 basis points. The yield curve is extraordinarily flat. It's actually inverted. So if you think about where the Fed funds target rate is right now, which is, I believe it was 1.75, and now they added 75 more, so it's at 2.5. And then you look at the 2-year note yield, which is plus or minus 3, and the 5s comes down to 2.9, and the 10s are 2.77. That's an inverted yield curve. That almost always is telling you you're going into a recession. Like historically, that's a red flag. Back to what I said before, don't take what I'm saying and say, oh my God, I can't invest in anything. We're going into a recession, the yield curve's inverted. We're in an inflationary environment. You actually need to invest. You just need to invest in defensive strategies. I actually believe development is a defensive strategy when proven to be well executed, because we have such a large profit margin. Another way of answering your question, Kai, because your question is about cap rates. Cap rates, which are both, they're 2 main things. It's interrelated. But a cap rate is the unlevered return on an asset if purchased all equity. So if you buy $1 million property and it's giving you $100,000 of income day one, you bought a 10 cap. That's a cap rate. What a cap rate also is your multiple on earnings. So if you ever think about words like a P ratio in the stock market, or you'll hear the stock market multiple used to be 25, now it's 17. And that's kind of what's happened this year. That's our cap rate. And earlier this year, our cap rates were sort of a 3.5 cap, which that's a 28 to 30 multiple on earnings. Now it's more like a 4 to a 4.1, 4.2 cap, and that's a 24 to 25 multiple on earnings. So you've seen compression in multiple, or in other words, rising cap rates, but the fundamentals of multi are extraordinarily strong. So our EBITDA, or we call it net operating income, NOI, is much higher than it was last month, or the month before, or the month before. So on the one hand, our valuations are going up because our net operating incomes are going up. On the other hand, our multiples are compressing, so that hurts the value, the terminal value of the asset. In all of that soup, I would say there's been a correction at the asset level of anywhere from 3 to 5, maybe 7% at the asset level. That's what's happened in multifamily real estate. The fundamentals remain strong. We're still massively underhoused. We don't have enough housing in the US. The other thing that's happened, and I think a lot of you have seen this, the mortgage rate in January was 3% on a 30-year fixed mortgage. Now it's 5.5%. Well, think about the growth markets we're in. What was the cost of a home in Florida, in Nashville, in Phoenix, in Denver 2 years ago? Where is it now? So you're looking at markets that the value of the homes have gone up 30 to 40% in 2 years, but the interest rate is almost doubled. And so what's happened is there's just millions and millions of people that want to buy a home and they can't. They can't afford a home. And we call that's a trapped renter. And so that increases our demand segment and allows us to continue raising rents, which we are. I love the fundamentals of multi. It's the highest returning, lowest volatility asset class in real estate for the last 30 years. It's not by accident that we're here and it's all we do. I think looking forward, the fundamentals are really strong to keep that streak alive. And the last thing I'll say is, remember, we're an essential consumption. There's a reason it's high returning and low risk. You don't get to sub out housing. You can elect in a recession, if that's where we're heading. You don't have to go to dinner out. You certainly don't have to take a business trip. We're having this wonderful conversation virtually, right? But you do need a place to live. And if anything, I think the move to virtual labor is benefiting our demand set, because your home can become your office, and increasingly it is. Tom, back to you.
So there's a couple of questions relating to climate change and therefore market selection, and I'll try to lump them all together. But the questions generally revolve around water shortages, heat waves, that sort of thing, which are in the news today. And how does that affect our market selection? And I'm going to take it into a couple different parts. The first part is the idea of, are we worried about climate change in our investment thesis? And the answer is yes. We're very aware of it. And I think Phoenix is the perfect example, right? You've built an MSA of 4.5 million people in the middle of a desert, where water is an issue. That's not a new issue to Phoenix. It's been that issue since they founded Phoenix 150 or 180 years ago, whatever it was. So it's always been at the top of the mind for people of Phoenix, for people of Arizona. And the shortage that we have today in Phoenix is nothing new. It's been going on for hundreds of years. And they always are focused on creating a solution. And the newest solution in Phoenix, for example, is a desalination plant. And it's not just talk. They've been working on this solution for more than 20 years. Like desalination, don't you need salt water in order to desalinate? And the answer is yes, you do. And the governor of Phoenix, the last several governors, have been working with Mexico to pump water from the Pacific Ocean, the Gulf there, into a desalination plant and up to the Phoenix Metro. And as of about a month ago, they approved $1 billion in spending to actually build that plant. So there is a lot going on all the time, even when it's not in the headlines, to make sure that these catastrophic world-ending events are mitigated, and they're always at top of mind in people in those communities. And as an investor within those communities, we're on top of those movements. Now, the broader question of market selection of would we ever consider investing in different metros that are maybe in the north where you don't have water shortages or you don't have quite the same heat waves or whatever the case may be? The answer is yes. We're always evaluating markets. We have built an AI platform that helps us with market selection. It processes about 2.7 billion pieces of data each month that scrapes from public data that helps us make those market selections. Now, we're in the markets that we're in. We've chosen them to be in them long term, but we're always evaluating, are these the best markets we should be in for the next 5, 10, 15, 20 years? What makes a real estate investment selection most profitable is job and population growth. So you need to have job and population growth to have the highest probability of success in any real estate investment. In the Southeast United States, Southwest United States, and Texas are the highest population growth right now. And that's, again, what Dave touched on at the beginning of the webinar was business friendly, tax friendly, quality of living, and affordable living. And the markets we're in have those, and we believe they'll have those going forward. And what some of the Northeast and the coastal states lack are the high quality of living, the affordability, and then the business-friendly nature within those states. So we are constantly evaluating, we're constantly making sure we're in the right states, but I don't see us making any major shifts over the near term to different markets, because we believe over the next 5, 10, 15 years, these markets will outperform all the others. And we've seen it so far in the last 7 or 8 that we've been really tracking the data in each market and the rent growth in each market. We have continued to outperform in the markets that we've selected, which is a big piece, again, of selecting the right manager and selecting the right markets to make sure that your investments will outperform.
Yeah, Tom, there's no city in the country with more water than Chicago. We have a lot of water, and it's a lot of fresh water. And, you know, Illinois is one of the largest loss of population, and Chicago is population in the country. That could turn around. I'm not suggesting that in 100 years it won't reverse, but it certainly doesn't feel like, and the data isn't suggesting that that's going to reverse anytime soon. We're a marriage of data and also our own team's experience. We do both. You know, the data doesn't make a decision for us, but we certainly pay attention to it. And if it's disagreeing with our cumulative experience and feel, we're questioning the assumption for sure, because the data doesn't lie. It's been incredibly predictive. To give you an idea, last year, our machine learning predicted on average 15 to 18% rent growth in our markets. That was preposterous. I mean, our rents usually grow 3 to 5%. And they came in at, you know, anywhere from 18 to 23. Like, in other words, the data was right. And we were the ones, you know, with all our cumulative field that didn't get it, right? So you do have to pay attention. And there's nothing suggesting that water, which is a concern, it's just not anywhere near as important to people as the other things Tom mentioned, which I won't repeat. I'm going to answer a couple questions. One's very easy. Do we get a K1 and growth on 4? Yes, you get a K1. It is consolidated, so you'll get one K1. You won't have to worry about multiple state filings, although obviously we're investing in multiple states. So it'll be rolled up into one. We work really hard to get those K1s out on time and understand your own tax deadlines as well. So now I'm going to combine 2 questions. Tom, thank you for your question. Tom had a question about construction costs and lumber. Oh, I'm sorry, that's Jacob. Jacob had a question about construction costs. And I'm going to interrelate that to another question, which was, what is happening? Because I mentioned cap rates have expanded, but NOIs have also expanded. So the question was, if you underwrote all these deals in January or late last year, is the expected value the same now? Is it worse? Is it better? And I'm going to combine those 2 questions. So if you look at the expected value of all these deals, on the one hand, you have a higher cap rate or a lower multiple on earnings today. That's bad. On the other hand, you have rents that are going up much, much faster than we projected. In fact, I mentioned earlier, we don't even trend rents in our models, and yet they're going up right now 5, 7, 8, 10%. I started to mention this earlier. The CPI, over 25% of the CPI is rent. It's the biggest mover in CPI. And so when you see the CPI up 8 or 9%, if you're in this fund, part of you is kind of happy, because that means your rents are going up, which is a huge driver in the value of this fund. So that's good. We're seeing that. And then in terms of the question Jacob asked about lumber specifically, lumber is the largest input cost into our deals. On average, 2 to 2.5 million of lumber savings have been realized over the last 4 or 5 months. And what's happened, and if you think about that, in this fund, if you have 10, 12 deals, it adds up. You're talking about 20 million of savings. So that's obviously good. So my short answer to the question about is it better or worse, it's very complicated. And I would say on average, it's about where it was. So I would say the underwriting that was done in January is very similar to what we're seeing now, and certainly within the ranges that we highlighted, and Tom talked about a bit as well when he was talking about the individual townhome deal in Atlanta. It's complicated is the answer, but I believe it's perfectly accurate, and if anything, conservative to what we underwrote. A lot of the underwriting we did was with lumber at 1,000 board foot, 1,200 board foot. And so we have to use that, even though historically lumber has been 300 to 400 board foot. I'm not kidding. It went up 3x. And so these are massive moves in products that really didn't have that type of volatility before. And what's happened, the home builders have really pulled back. Think about what I was saying earlier. So now not a lot of people can afford a house because the values have gone up so much, the mortgage rates have gone up so much. Well, the home builders see that, and their housing starts are way, way down because they know that there's plenty of buyers, but they're not buyers that can afford it. And so once they start pulling back on development, new development, you've seen a huge retracement of some of these commodity prices. Lumber is the best example. Today, I checked earlier this morning, it's hovering right around 550 to 600 board foot. That was over 1,000 board foot, 90 days ago. So that's how volatile it's been. And it'll continue to be volatile. And what we'll do to mitigate that is we're extraordinarily conservative with our underwriting, and then we build in huge inflation factors. If it's going to take us 3 months in order to buy lumber, we'll build in, 1.5% a month inflation factor. Think about that. That's 18% annualized. So, this is big stuff, right? So, and what's happening with overall construction costs, and this should be good news in general, not just to this fund, but to the overall economy. It's not going lower. Prices haven't gone lower, but the rate of increase has been extraordinary. So, if I had this webinar 4 months ago, we would have said, yeah, construction inflation, it feels like it's 12 to 14% annualized, because it was. Now it feels like it's 2.5 to 4. Well, what's interesting about that is now you're kind of in the target range of what the Fed wants. I'm not saying that's where inflation's heading. I'm just saying within construction, that's happened. Tom, do you have anything to add to that?
No, I agree with that. And I would add to the underwriting, just clarity in many of the questions, either pre or since we started the webinar, have revolved around the recession and how we take that into consideration, how that might affect our profits, the profitability of the deals. The short answer is we have, within our machine learning, we have a base case, meaning no recession, a moderate recession, and extreme recession scenarios. The vast majority of our underwriting is in line from a rent perspective with a moderate recession scenario. So we've actually taken this idea of recession into consideration in our underwriting, in addition to higher costs, as Dave was talking about. It would be extraordinarily unlikely to have a moderate or extreme recession and have higher costs, because by definition of a recession, growth has slowed, and therefore the demand for those supply and those products is lower. So we've actually kind of double hit our underwriting from a recession perspective, where we've assumed lower rent growth, assumed lower rents in general, and still accounting for higher costs. So I just want to clarify one last piece on the underwriting there. I'll answer the top 2 questions as it relates to the investment strategy and the equity investments in each one of these deals. The first one is, both of them really revolve around how we're investing in these deals from an equity perspective. The first is some of the equity investments are as low as 10 million. And are other people investing in these funds? The short answer is no. Our capital is being invested alongside our development partners, and those development partner co-invest can be as low as 5% of the total equity need, or as high as 25 or 30% of the total equity need. So a lot of times our equity check is a function of both the size of the deal as well as the co-invest from our partner, and that can scale up or down our equity commitment. Now, it's worth noting as well that we won't put more than 10% of the fund into a single deal. And if that's the case, we will do a sidecar to invest alongside the fund to help us mitigate risk. So investors in the fund will have an opportunity to invest additional capital within the sidecar if they really feel like they like this fund and want more, or like this deal and want more exposure to the deal. The second question along those commitment lines is Growth Fund 4 investing in other origin projects such as QOZ or other stuff? The answer is no. The Growth Fund 4 deals are Growth Fund 4 deals, and what you see here is this fund. Dave, hopefully I didn't take one you were going to talk about.
Thanks, Tom. Okay, so a couple questions that I'll kick out. All right, does the unit price change? This is anonymous, thanks for the question. Does the unit price change during the raise period? No. And it's a great question because some of our funds are open-ended and it potentially could. This is a closed-ended fund, so it won't. In fact, there isn't a unit price. This is a callable capital fund. You'll have your capital called and then it'll be distributed when we refi or have cash flow or sell. So that's an easy one. Another question. This is a great question, and thank you for asking it, Jason, because I was remiss and didn't cover this. So Jason wants to know when the next capital call will happen. And I've been having conversations with Tom, but also Dave Welk and Mark Turner, who runs investment management, and our capital raising team. And the short answer is we believe there's going to be a capital call in the October timeframe, and then another one at the end of the year. And in total, it'll be about 75 million. And so, as we stand today, of course, it's a moving target because we're going to be raising money throughout. But as we stand today, that would be 50% of what's raised. If we didn't raise another dollar, will be called by the end of the year. And it's really reflective of what I said earlier. And Tom also stressed, we've been working on this fund for a year and a half. And that's one of the huge benefits to every investment partner in the fund or anyone who's on the call thinking about investing. It's fully sourced. We've been working on pre-development and getting these ready to start building for quite a while. And so, yes, we'll be allocating this capital quickly. We had another, I'm just going to kick out a few more, Tom. There was a follow-up, somewhat similar question about would Growth Fund 4 ever invest in another fund, asset, or vice versa. QOZ was mentioned. The answer is no. We won't do that. We want your unique investor base. You're going to have your own investments. And however, if a deal is too big, this is a 10% cap per deal, we would do a sidecar. And so if a deal requires 30 million and the fund isn't 300 million, then we would say, okay, we're going to have a co-investment, and that co-investment would be only made available in a priority way to this group of investors. So Growth Fund 4 investors would have the option to invest more in that deal if they chose. Obviously, if the investment isn't fully invested by that group, we have thousands of other investors who would then be given the opportunity, but you will have first look at all those deals. And in the past, all the sidecars have been filled by that group, by that investment group, QOZ by QOZ investors, for example. Tom, back to you.
Sure. There's several questions about hitting the cap in this, whether or not we do it, what it looks like if and when we do, and how the capital call structure would work around that. And they're related and not related at the same time. So what happens if we don't reach the cap? We will reach 200 million. I feel very confident in that. And I feel very confident that we'll reach 250 million as well. We've been, again, raising this for about 7 months, and we're more than halfway to our cap of 250 million. So it's highly likely we will reach the cap. Deals always fall out, so it's possible that some of the deals don't get done that we think will get done, but it seems unlikely. Again, as Dave mentioned, this is a very, very big fund. Once we hit that cap, there will be no additional cap, no additional investment, and we'll have to launch Growth Fund 5 or whatever the name of it will be at that point in time. So I would encourage, if you're interested in like the profile of this investment, to take action sooner than later. We will continue to raise this until we either hit the cap or until early 2023. But in reality, I do believe we hit this cap, and we'll have to launch our next fund with new investments. And we are already, again, looking at those investments today for 2023 and beyond. And the last question as it relates to the cap is, if we hit the target of 250, will there be a capital call? Yes, the capital call will generally be on a quarterly cadence. As Dave mentioned, 75 million is expected to be called between now and the end of the year. And that would put us at, I want to say something like 150 million called, plus or minus. And we'll continue to call really on a quarterly basis. Even when we close the fund, because we hit the cap, that doesn't mean all of the capital will be called at that point in time. We'll call it as it's needed. As the deals progress through their life and we need more cash to invest, we'll continue to call that capital probably on a quarterly basis until it's fully called in early or mid 2023.
We have a question about 1031s. It's anonymous. Thanks for the question. A 1031 is a tax exchange. So if you sell a property and generate a taxable event, you can tax defer to another real estate investment. 1031s are not eligible for this fund. And then the question is, I understand 1031 isn't eligible for this fund, but if I have gains in this fund, can I then take those gains and 1031 them somewhere else? And the answer to that is no, you can't do that either. And the reason is all of the people in the fund would need to follow you into that investment in the other place. So don't invest in this fund if you want 1031s in and out. It's not the vehicle for it. My personal opinion is none of those 1031 vehicles, they're called TICs, tenants in common structures. They're extraordinarily bad products, and I would highly recommend you don't get into them. Email me at david@origininvestments.com. I'm happy to tell you why. We've sourced a lot of TIC deals that have gone very, very bad because they're structurally very, very weak. And they're very high fee too. So again, the ethos of Origin, my partner and I are the largest investors in our funds. We're taxed. We want to make good investment decisions for us and all of our partners. And I also want to be an advocate for people, high net worth individuals who really do need real estate in their portfolio. And we want to advocate for you. So one of the ways we do that, by the way, if you go to our education section, there's over 200 videos and articles that we have written or we have produced on actual deals. So anything from, how to vet a manager, how to vet a deal. There's some that are very, very in the weeds about, the math behind it. It's a resource for you. So whether you're our partner or not, if you have any question about real estate and mechanics, it's there for you as a resource because we're serious about it. We want you to make better decisions. The last question, Tom, I know we're over, I'm going to take is Kumar. Thanks for the question. And Kumar is asking about the end of the development period and how is equity returned and preferred and the preferred return returned. And so I just want to take you through it again because I probably wasn't clear. Anytime there's confusion, it's my fault, right? So Kumar, you have the option as an investor, every investor does in this fund, to either be taken out fully, meaning all of your equity is returned, the preferred return that you've accrued is returned, and all of your profit split is returned at that point. And so that's 4 years out in the future. That's the returns that we showed that were somewhere between, on the low end, 8%, on the high end, 22%, and the corresponding multiples. That's what that slide is. That's the slide if you say, hey, I just really wanted the development exposure, and now I want out. And so you're fully taken out at that point. Or you can choose to stay in the fund. You're still getting those same returns from years 1 through 4, but you're not taking the money. You're staying in, we're lowering the management fee, and you're getting long-term appreciation without the taxes because you're not getting out. So you don't have to pay the capital gains. You're letting the whole thing run over time. And so if I haven't answered this correctly, David at Origin Investments, I shouldn't say correctly, clearly, email me and we'll talk about it some more. There's nothing here that's that complicated, but a lot of people aren't used to the language. And so we want to make sure that everyone's clear. Okay, that's it. We're 9 minutes over, Tom. Thank you so much for your time. I know that you're super busy. And so we really appreciate it. And thank you all for your time. We value your time. If you're an investment partner, we value you as an investment partner. And we hope that we show you that every day with our investment across people into the platform, the service. and importantly, the returns and risk management. I've never been prouder of our firm in this really, turbulent time. We've been able to protect and grow your capital, and that means a lot to us, and we thank you for being our partner. Have a great day, everyone.